What if I told you that the single biggest difference between the rich and everyone else isn't how much they earn? It's that they make money while they sleep. Welcome to the Complete Beginner's Guide to Investing. In the next 12 minutes, I'm going to show you exactly how to start building wealth from zero, even if you've never invested a dollar in your life. Here's a fact that changed my life. If you had invested just $100 every month into the stock market starting 20 years ago, today you'd have over $60,000. That's the power of compound interest, and it's available to anyone who starts. But here's the problem. Most people never start because investing seems complicated, risky, or only for the wealthy. By the end of this video, those excuses will be gone forever. Let's begin. Before we talk about how to invest, we need to understand why investing is non-negotiable if you want financial freedom. Let me paint you a picture. Meet Sarah and Mike. Both are 25 years old. Both earn $50,000 per year. But they make one different decision. Sarah saves $500 per month in a regular savings account with 1% interest. Mike invests $500 per month in a diversified portfolio with an average 8% return. Fast forward 40 years. Sarah has saved $240,000. Not bad. But Mike has $1.5 million. Same contributions. Completely different outcome. This isn't magic. This is math. It's called compound interest, and Albert Einstein reportedly called it the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Here's why this matters. Inflation is silently destroying your purchasing power every single day. At 3% annual inflation, your money loses half its value in 23 years. Investing isn't optional anymore. It's survival. Now let's explore the investment universe. Think of it like a menu at a restaurant. You have options ranging from super safe to potentially explosive. First, we have bonds. When you buy a bond, you're essentially lending money to a government or company. They pay you interest and return your principal later. Bonds are the safe option. Lower returns, but lower risk. Think of bonds as the vanilla ice cream of investing. Reliable, but not exciting. Next, stocks. When you buy a stock, you're buying a tiny piece of a company. If the company grows, your stock becomes more valuable. If they pay dividends, you get regular cash payments. Stocks historically return about 10% annually, but they can be volatile. One year you're up 20%, the next year down 15%. Over decades, though, stocks have been wealth-building machines. Then we have real estate. This includes buying physical properties or investing in real estate investment trusts, called REITs. Real estate can provide rental income and appreciation. It's tangible. You can see it, touch it, live in it. But it requires more capital and management. Cryptocurrency is the new kid on the block. Bitcoin, Ethereum, and thousands of others. Massive potential gains, but equally massive volatility. This is high risk, high reward territory. Only invest what you can afford to lose completely. And finally, index funds and ETFs. These are baskets of stocks that track entire markets. Instead of picking individual companies, you own a piece of hundreds or thousands of them. This is how most successful investors build wealth. Warren Buffett, one of the greatest investors of all time, recommends index funds for most people. Successful investing rests on 4 pillars. Master these, and you're ahead of 90% of investors. Pillar 1. Start early. Time is your greatest asset. A 25-year-old who invests $300 monthly until age 35 and then stops, ends up with more money at 65 than someone who starts at 35 and invests $300 monthly for 30 years. Let that sink in. 10 years of investing beats 30 years of investing, all because of time and compound growth. Pillar 2. Diversify. Never put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies. When tech stocks crash, bonds might rise. When the US market struggles, international markets might thrive. Diversification protects you from catastrophic losses. Pillar 3. Keep costs low. Every dollar you pay in fees is a dollar that isn't compounding. A 1% annual fee might sound small, but over 30 years, it can eat up 25% of your returns. Choose low-cost index funds with expense ratios below 0.1%. Pillar 4. Stay consistent. The market will crash. It always does. In 2008, the market fell 50%. In 2020, it dropped 30% in weeks. Investors who panicked and sold lost fortunes. Those who stayed invested and kept buying recovered and prospered. The market rewards patience and punishes panic. Your investment strategy should evolve as you age. Here's a roadmap. In your 20s, this is your wealth-building decade. You have time on your side, so you can afford more risk. Allocate 80 to 90% in stocks, 10 to 20% in bonds. Max out any employer retirement match. That's free money. Start a Roth IRA. Your contributions grow tax-free forever. And most importantly, invest in yourself. Your earning potential is your greatest asset right now. In your 30s, you're likely earning more, but also have more responsibilities. Keep 70 to 80% in stocks, 20 to 30% in bonds. Increase your emergency fund to 6 months of expenses. Start college funds if you have children. And don't neglect retirement savings even as expenses grow. In your 40s, time to get serious. Balance shifts to 60 to 70% stocks, 30 to 40% bonds. Catch-up contributions become available. Maximize tax-advantaged accounts. Review and rebalance your portfolio annually. In your 50s and beyond, preservation becomes priority. 40 to 50% stocks, 50 to 60% bonds, and cash equivalents. Consider annuities for guaranteed income. Plan your withdrawal strategy. And remember, it's never too late to start. A 50-year-old who invests $1,000 monthly until 65 can still accumulate over $300,000. I've made every mistake I'm about to share. Learn from my failures so you don't repeat them. Mistake I. Trying to time the market. Nobody can consistently predict market tops and bottoms. Not professional fund managers. Not financial gurus on TV. Not you. Studies show that missing just the 10 best market days over 20 years cuts your returns in half. Time in the market beats timing the market. Every single time. Mistake 2. Following hot tips. Your friend's stock tip. That Reddit thread. The email promising 500% returns. They're all traps. By the time you hear about a hot investment, the smart money has already made their profits. Do your own research. Invest in what you understand. Mistake 3. Emotional investing. Fear and greed destroy portfolios. When markets crash, fear screams sell. When markets soar, greed whispers buy more. Both emotions lead to buying high and selling low. The opposite of what you should do. Automate your investments. Set it and forget it. Mistake 4. Not having an emergency fund. Before you invest a single dollar in the market, you need 3 to 6 months of expenses in a savings account. Why? Because when emergencies happen, and they will, you don't want to sell your investments at a loss to cover them. Mistake 5. Ignoring taxes. Different accounts have different tax treatments. Regular brokerage accounts trigger taxes on gains. Retirement accounts offer tax advantages. Roth accounts grow tax-free. Understanding tax implications can save you thousands over your lifetime. Let's get practical. Here's exactly how to start investing today. Step 1. Open an account. For beginners, I recommend low-cost brokerages like Fidelity, Vanguard, or Schwab. No account minimums. Commission-free trades. User-friendly platforms. Step 2. Choose your first investment. Start with a total stock market index fund or an S&P 500 index fund. These give you exposure to hundreds of companies instantly. Low cost. Instant diversification. Perfect for beginners. Step 3. Set up automatic investing. Schedule automatic transfers from your bank account to your investment account. Even $100 monthly adds up to $1,200 yearly. Consistency beats intensity. Step 4. Increase over time. Every time you get a raise, increase your investment amount. Live on what you earned before the raise. Invest the difference. This is how wealth is built quietly, consistently, automatically. Step 5. Review annually. Once per year, check your portfolio. Rebalance if needed. Ensure your asset allocation still matches your age and goals. Then leave it alone. Patience is the ultimate investment skill. We've covered a lot. Let's recap the essentials. Investing isn't just for the wealthy. It's for anyone who wants their money to work for them. Start as early as possible. Diversify across asset classes. Keep costs low. Stay consistent through market ups and downs. And most importantly, just start. The best time to start investing was 20 years ago. The second best time is today. Every day you wait costs you compound growth that you can never recover. You now have the knowledge. You have the roadmap. The only question is whether you'll take action. If this video helped you, hit the like button and subscribe for more financial education. Drop a comment with your biggest investing question. I read every single one. Remember, wealth isn't built overnight. It's built $1, one investment, one day at a time. Your future self is counting on the decisions you make today. Don't start now. Thank you for watching. And I'll see you in the next video.